Good afternoon, ladies and gentlemen. Welcome back to this week market review. As usual, I have Mr. Gerald Wong back with me too. How's your weekend?
It was good. I think it was a very hectic week in the markets. We saw quite a number of significant developments in terms of the US inflation data, the Middle East conflict. In Singapore, we also had some of the economic data coming out as well. So looking at all of this data, we had to distill it and understand how that will affect the financial markets.
Yes, and last Wednesday we had a nice chat with our members on our monthly SIAS. So pretty illuminating as well. And of course, after the SIAS session, we have the CPI data, which comes in a tad hotter, a little bit hotter than analyst expectation. And of course, we see that market actually reacted to that on Friday towards the close of the week. This is down in the red. So, Gerald, will you break it down for us in today's weekly market review?
Sure. Okay, so quite a number of developments today that I will share. But before we go into the discussion, today's session is for education purposes only, and it should not be taken to be financial advice in any way. Okay, if you find the session helpful, do leave us a review on Google, either via this site that is shared or by scanning the QR code. And last but not least, if you would like to join the SIAS session that Sunny mentioned earlier, that is held on a monthly basis for SIAS members. For those who want to join, it is only for $1 per month or $12 per year. Okay, once again, you can go to this QR code or the link that is provided to be able to join as a member. Okay, so what we saw last week is actually a very mixed market performance. We saw the fall in the markets on Friday, but across the entire week, actually the S&P 500 came up by 0.5%. We saw some of the energy and industrial stocks doing okay as well, which is why we have the Dow Jones actually rising by 0.8%. But on the other hand, the tech stocks actually suffered a bit and were down by 0.2%. Closer to home, the STI actually rebounded by 0.4%. So a mixed bag of performance, given that there were quite a number of different moving parts for the market in the past week. Okay, so we'll look at what are some of these major events that actually moved the market. Okay, so one of the key things that a lot of investors were looking out for, this is always a very closely watched data point, is the US Consumer Price Index data. And what we saw in terms of the September data is that the headline number actually rose by 3.7% compared to the previous year. And this is actually a similar increase like what we saw in August. Okay, so what we have seen is that after moderating in the months of June and July, it is now back to a 3.7% year-on-year increase level and slightly above what the market was expecting. So that is driving concerns that inflation might remain persistent. And with that, the US Federal Reserve might have to keep interest rates higher for a longer period of time. Okay, so that is effectively one of the key data points that came out last week that actually led to renewed concerns about higher interest rates once again. Okay, we also saw the International Monetary Fund coming out with its projections for 2024. Once again, this is something that is closely watched because as an international organization, they would actually provide their forecast of growth and inflation on a quarterly basis. And what we see here is that in terms of their forecast for global growth going into next year, it is just expected to be 2.9% growth in 2024. So what this effectively means is that the kind of growth that we saw in 2023 might likely be sustained going into next year, but at a slightly slower pace. Okay. The other interesting point that came out from the IMF projections is that inflation for 2024 is likely to remain slightly elevated. And compared to their forecast just 3 months ago, they actually increased their inflation forecast for 2024. So that actually ties in with what we saw for the US CPI data, which is effectively that inflation is not coming down as much as what some of these policymakers would have hoped to have been able to achieve. Okay, we also look at some of the Singapore data which came out last week. If we were to look at the Singapore GDP growth data for the third quarter of this year, then based on the flash estimate, Singapore's economy actually grew by 1% compared to the previous quarter. Okay, so that provided some form of relief to investors because if you were to look at the past few quarters, the growth has been fairly weak. In fact, after the second quarter, we almost went into a technical recession with 2 consecutive quarters of GDP decline. But thankfully, for the second quarter number, we managed to grow by 0.1%, and hence that allowed us to avoid a technical recession. Okay, so with this GDP growth number that came out, what the Monetary Authority of Singapore also did is that they left the monetary policy unchanged at its semi-annual monetary policy decision meeting. So effectively, what we have seen is that, okay, the Singapore economy is actually not declining or doing too badly. And as a result, the MAS has actually kept the exchange rate policy unchanged as well. Okay, so how has this actually translated into the market? We saw earlier that the STI saw gains of 0.4% last week. And some of the gainers were actually led by stocks with quite peculiar kind of characteristics that we will go into more detail later. So ST Engineering was up by 3.4%. We have some of the REITs actually starting to see a bit of a rebound. So CICT up by 2.8%, Mapletree Logistics Trust by 2.6%. Some of the offshore and marine related names also did fairly well. We have got Yangtze Shipbuilding up by 2.5% and Seatrium up by 2.4%. Okay, so we'll go into some of these stocks later to understand what is driving the recovery. In terms of top losers, we have got SIA down by 1.7%, Wilmar 2.2%. Some of the Jardine related names also declining, with Jardine Matheson down 3.8% and DFI Retail Group down 4.1%. Sembcorp Industries also continued its decline with a fall of 4% last week. Okay, so we'll look at some of these names that had significant movements in the past week. And this will include ST Engineering, where we saw a general improved sentiment towards global defense stocks because of an escalation of the Middle East conflict. Okay, together with the escalation of the Middle East conflict, we also saw oil prices going up to close to $90 per barrel. And some of the oil and gas related stocks like Seatrium actually having a bit of a share price bounce. Last but not least, we saw some of the REITs actually becoming the top gainers, including CICT and Mapletree Logistics Trust. And that is because we started to see the 10-year government bond yield starting to come down a bit. Okay, so we'll start with ST Engineering, one of the stocks that has actually bucked the weakness in the Singapore market. So if I were to look at the performance here, effectively, in the past week, reaching close to $4 per share, which is actually the highest level so far this year. And that actually led to a lot of questions around what is driving this strong performance for ST Engineering. Okay, so if we were to break down the performance of ST Engineering, I think for investors who may not be so familiar with what the company does, one of the key things to realize is that it is actually a company with exposure to the defense industry. And if we were to look at the breakdown of its revenue in the first half of this year, what we see is that about 1/3 of the group revenue actually comes through from defense-related spending. Okay, so commercial is about 3.3 billion of its 4.9 billion revenue. Defense is 1.6 billion of the 4.9 billion revenue. Okay, and what we see here is that over the past few quarters, the revenue coming through from defense has been steadily increasing. Okay, so that might be one of the reasons why investors are taking notice of ST Engineering, because of the escalation of the Middle East conflict. Okay, the other point to note about ST Engineering is that if we were to look at its order book, it reached a record high of 27.7 billion as of June this year. That was actually a 20% increase from the level in December 2022. Okay, so because of the increase in orders it has in the defense-related sectors, because of a pickup in some of the commercial work that it is doing, the order book is actually now at a record high. Okay, so that is effectively ST Engineering and why the share price has actually done so well. Next, we also have Seatrium, where we saw the share price having a bit of a rebound in the past week. What we see here is that after reaching about 14.5 cents in late September, the share price actually came down together with the decline in oil prices. But that actually rebounded in the past week as oil prices reached $90 per barrel once again. Okay, so this is the chart that we see for oil price. Effectively, in the second half of this year, it has had a very strong rebound. But then that actually corrected in late September and towards early October due to concerns that the Fed will keep interest rates higher for longer, and then as a result, leading to a slowdown in the global economy. But with the breakout of the Middle East conflict, what we see here is that oil prices have actually recovered very strongly from the low 80s level to now back to about $90 per barrel once again. Okay, so that is helping to drive sentiment towards the oil and gas related stocks, of which Seatrium is actually one of the names that are seen to be exposed to higher oil prices. What we also see is that, like ST Engineering, Seatrium's order book has also recovered very strongly. After the merger with Keppel Offshore Marine, what we see here is that the order book is now at a high of about 20 billion compared to where it was in end 2022, which was at 6.75 billion. Okay, so it is definitely getting some orders on the oil equipment side, together with the improvement in oil prices. Okay, next we'll talk about the REITs, and in particular CapitaLand Integrated Commercial Trust, where we also saw a bit of bounce in the share price in the past week. Okay, so what we see here in this chart is that after we saw the share price reaching about $2.10 towards May this year, as the 10-year government bond yield continued to move up, the share price of CICT actually came down to reach actually below $1.80 earlier this month. Okay, so what is actually driving the rebound in CICT share price? A number of factors. So first and foremost, if we were to look at the 10-year government bond yield, it actually declined in the past week. Okay, so looking at this chart, it reached a high of about 3.5% in early October. But once again, we started to see a decline in the past week, such that it is now closer to the 3.3% level. Okay, you might be wondering, okay, we saw higher inflation data. What is actually driving this fall in the 10-year government bond yield? Okay, so first and foremost, we see that investors are going towards safe assets, of which government bonds are actually one of them. And that is actually driving the bond yields to decline. Okay, so the other factor that is actually driving this movement is actually that if you were to look at what the Fed is actually saying now, as the 10-year has actually started to move up very sharply in the US, investors are starting to realize that, oh, maybe they don't have to raise interest rates as much as before. And that is also causing a secondary effect in which the bond yields are starting to come down as well. Okay, so why CICT? I think one of the reasons that investors like CICT is because of the fact that if we were to look at the breakdown of its revenue, it is very diversified. if we're to look at the exposure, it has got, say, Singapore retail, it has got Singapore office, its retail is split between suburban and downtown. And that is actually driving investors to think that even if there's going to be a very sharp slowdown in the economy, it is actually one of the most diversified REITs with income streams coming through from different segments. Okay, so in a nutshell, that is really why CICT might have seen that kind of share price rebound in the past week, because of the fact that the 10-year government bond yield has come down slightly and investors might perceive it to be a fairly diversified REIT. Okay, and if we're to look at the valuation of CICT at this point in time, from a price to book perspective, it is trading at about 1x price to book. So quite close to where it was in the historical average. And that might once again be driving investor interest towards this name. Okay, so we saw a fairly packed week in terms of economic release last week, and going into this week, what we are seeing is that we will have the Singapore result season actually starting. So we have all the Keppel related names reporting this week, starting with Keppel DC REIT today, followed by Keppel REIT tomorrow, and then we've got Keppel Pacific Oak US REIT on Wednesday, before Keppel Corp on Thursday. We also have a 1-year Singapore T-bill auction coming up on Thursday. So that is once again something that investors will look out very closely for after we saw a decline in the 6-month T-bill yield in the auction last week. Okay, so with that, I will end up my summary of what has happened in the markets and hand over to Sunny, who will share with us what does this actually mean from a technical analysis perspective.
Okay, thanks Gerald for the insightful and very detailed. So let's start with the index. So we can see that last Friday, STI index actually fall by about 1.02%, a more than 1% fall. And this morning, Monday morning open, we are seeing that the index fell another 0.43%. So we are back to the previous support low, the level of 3155. That support level will still stands, and the previous time we spoke that although we say that this is the support level for the STI index, but we do not see that the index will be able to rebound back very fast as the year-to-date high. So this is actually true to what we have spoken earlier. We will have some kind of consolidation around this area of the 3155 area, because there's still some uncertainty whether it's regarding to the Middle East conflict, or whether the interest rate going to be raised again this year, or whether these people still flying. So those things that we are very concerned investors that's preventing STF from the rate of trading between the 3155 level and even the peak that you see somewhere in October, that's around the 3 to 4. I'm waiting for my Hang Seng Index to load. Okay, there you go. So this is the Hang Seng Index movement. So on top of last week news that the CPI come in a bit hotter, we also have some data coming in from the Chinese. It shows that the consumer prices as well as the manufacturing prices are also starting to look weaker, and hence we have a pullback on the Hang Seng market on Thursday as well, and Friday as well. So that means that we are not likely to go and see a rebound very soon. Although the previous level of support, this double bottom area over here, which I'm looking at earlier at around the 17,585 level, this is still the support level that we are looking at for the Hang Seng Index. If the index were to push lower towards the year-to-date low around here, around the 17,000 level, I believe there might be some policy announcement or policy stimulus coming in for the Chinese authorities, which a lot of analysts or economists are expecting. So that's why this support level of 17,000 13,587 is a good support level for Hang Seng Index. But same as the STI, also, but we can accumulate around this level. Next, let me move to the US indices. First, let's touch on the Dow Jones Index, which is the only index among the three major US index that made small gain on last Friday, up 0.12% or about 39 points. So although we have a positive Friday, if I'm going to zoom in over here, you can see that the candlestick development here, we have a very long top wick, meaning a lot of sellers at the of 33,900, just 100 points below the 34,000 handle. And the closing price of the closing index point of 33,670 points is actually slightly below the 20 days moving average, which is the black line, or the Bollinger Band at 33,725. So it is still not looking good according to the moving averages, and there's still a lot of pressure on the Dow Jones Index. Support level will definitely be the near-term low that we see over here on the 6th of October, that is around the level of 32,800 level. So if we pull back towards the 33,000 somewhere over here, this mini double bottom that we saw in June, it could be a good time to accumulate on the Dow Jones Index as well. So 33,000 handle is something that I'm looking at before I would take any action on the Dow Jones Index. Okay, next we have the S&P 500. Now, S500 also have a pullback after the CPI announcement. We can see that the candle development last week on Thursday and Friday was two big red candles. So this is a very negative sign. It tells us that sellers most likely have taken over control of the market, and hence there's more downwards pressure on the S&P 500 index right now. To close just slightly 2 points above the 20 days moving average. That is a very weak support to look at if you are going to use the 20 days moving average. More likely, we will first be looking at the support trend line, which connects the low in March as well as somewhere the low in October this year. So is somewhere hovering around the 200 days moving average, which is the red line. That's around the 4,269 points level. That could be the support level to look at. Or even close by, you can see that this zone over here where we see a lot of sellers support the S&P 500 index, that is also around the 4,220 points level, which would be a good support for S&P 500. Looking at the indicators, we see that MACD starts to converge towards the signal line. The MACD line converges to the signal line, which means that the uptrend momentum that we see since the beginning of October is starting to weaken already towards the October low of around 4,220 or 4,230 points level. The RSI is also crossed below the 50-point neutral mark. The latest reading on Friday was 46. So that means that a momentum is below the 50-point neutral mark already. So expect a bit of a pullback, in the next few weeks for the S&P 500, according to both the MACD and the RSI indicator. Okay, lastly, we move to the tech-heavy composite index. So the pullback was more pronounced, more obvious on the Nasdaq Composite Index. This is not a surprise because as the CPI numbers came out, right, the fears that we are going to have another rate hike this year, which is either on the 1st of November or somewhere in December, this could mean that the stocks that could be greatly affected by the hike in interest rate would definitely be the growth stock, which are the tech stock. So that's why the Nasdaq Composite Index pullbacks much more compared to both the Dow Jones Index and the S&P 500. Now, we still managed to close above the 20 days moving average using that as a support. 20 days moving average now reading at 13,354 points, and the closing of last Friday for the Nasdaq Composite was 13,407 points. So just about 8 points above the 20 days moving average. So if we manage to stay above that, then definitely yes, the uptrend that we see or the rebound that we see since the beginning of October will likely continue. However, that is a very weak support that we are looking at. If we get, then definitely we will be looking at this support line over here in green, which is connecting the low in March as well as October this year, and that could provide a bit of a support for the Nasdaq Composite Index. Below that, the next support level I'm looking at will be August, which is around the 13,180 points. Else, if we break this, then the next support will come in at the 200 days moving average, which is the red line at 12,960. So 13,000 would be more of a stronger composite index. So the indicators on the Nasdaq Composite Index is similar to the S&P 500 behavior. So the MACD line is actually converging towards the signal line. That means that the uptrend since early October is momentum is subsiding, and hence a pullback may continue. And the RSI has also crossed below the 50-point neutral mark, which means that momentum is actually starting to get weaker and weaker already, and hence now it's not a time to wait for the pullback to go much further until we go into a firmer support level around the 13,000. And then from there, let's reassess what the indicators are telling us again, and see if there is any signs that we are going to see a rebound based on the low of 17th of August. That is my brief roundup for most of the major benchmark index around the world. So anything to add on, Gerald?
So I guess quite a number of different moving parts in the market, and we're also going into the earnings season this week. We started to see some of the US banks reporting last Friday already. So I guess apart from the major economic data, the other thing that we also need to be starting to track more closely now would also be the upcoming earnings releases by the different companies.
Yeah, so going forward, we are looking at some of the banks has already started the earnings seasons already, and it's looking a little bit promising, but we will have to hold on to see how this earnings season turns out, and this may be the last catalyst that we have towards the end of the year.
That's right. Yep. So we'll be keeping a close lookout for it. And if you want a regular update, do join us for next week, weekly market review.
Okay, so that's all the time we have for this week. Thanks for joining us, and we'll see you again next week, next Monday, same time on our weekly market review show. Goodbye.
Thank you.